For decades, U.S. Treasury bonds have been the cornerstone of the global financial landscape. Central banks and investors worldwide have poured trillions of dollars into these securities, viewing them as a secure refuge for their wealth. Within this intricate web, Asia's colossal economies, particularly Japan and China, have held pivotal positions. However, recent shifts in this long-standing pattern have raised eyebrows and triggered alarm bells in financial markets. Reports indicate a startling development. Both Japan and China have drastically reduced their U.S. Treasury holdings by approximately 45%. This unexpected withdrawal has sent ripples of uncertainty through the markets, leaving experts to ponder the deeper implications of such a significant sell-off. Could this be indicative of a newfound alliance between these two nations? Or is it merely a pragmatic economic response to shifting geopolitical tensions? Historically, U.S. Treasury bonds have served as a vital instrument for the U.S. government, enabling it to cover budget deficits and fund various initiatives, particularly in the wake of the 2008 financial crisis. Central banks prioritized these bonds, bolstered by the perceived stability of the U.S. economy and the dollar's role as the world's reserve currency. Japan and China emerged as the largest holders during this era, essential players in financing U.S. debt while simultaneously stabilizing their own currencies. Yet, the geopolitical climate has shifted dramatically. Heightened trade tensions and tariffs imposed by Washington have prompted Beijing to reconsider its financial strategies. The risk of overdependence on American bonds has raised red flags within China, prompting a calculated pivot towards diversifying its reserves. This strategic maneuver includes investments in alternative currencies and commodities like gold, reflecting a desire for greater monetary independence. On the Japanese front, the situation is nuanced. Despite being a staunch ally of the United States, Japan is grappling with its economic challenges, marked by stagnant growth and high public debt. The Bank of Japan's long-standing monetary easing policy has met headwinds from rising inflation and exchange rate pressures, necessitating a re-evaluation of its bond holdings. In this landscape, reducing U.S. bond holdings appears as a tactical move to bolster domestic markets while addressing fluctuating currency values. Now, as both nations sell off a significant portion of their U.S. bonds during an unprecedented moment, the burning question arises: is there underlying coordination between Japan and China? Historical and political tensions would seemingly deter such collaboration. Yet the financial markets tell a different story. Both nations may individually be responding to protect their economies amid global trade conflicts. Simultaneous bond sales by Tokyo and Beijing may carry an implicit message to Washington: if you continue this aggressive posture against us, we possess the power to disrupt your financial leverage. While many experts refrain from labeling this as a clear-cut alliance, the eerie coincidence of these actions cannot be overlooked. What does it mean for the U.S.? If influential players like Japan and China offload their treasuries? Theoretically, such outsized sales could lead to falling bond prices and rising interest rates, exacerbating the budget deficit as the U.S. would be forced to offer higher yields on new debt. This chain reaction might thrust the Federal Reserve into a corner, necessitating recalibrated monetary policies that carry inflation or recession risks. Navigating through this financial labyrinth draws attention to the dollar's fragile reign as the world's reserve currency. With the potential for depreciation looming, Washington's response could include discreet diplomatic efforts aimed at persuading allies to rethink the pace of their divestments. While Japan remains a close ally, relations with China are fraught with tension, complicating the U.S. strategy to avert a market upheaval. As investors hold their breath, wondering how far these two nations will venture in reshaping their financial landscapes, one thing remains clear: the global economy is at a crossroads, balancing on the razor's edge of potential upheaval. Will the meld of national interests and international finance result in a more harmonized East Asian response, or will it escalate into a deeper conflict with the U.S.? As this story unfolds, the far-reaching consequences of these actions could reshape economic alliances and alter the balance of power on the world stage. Are we witnessing the beginning of a seismic shift in global finance? The question lingers, inviting contemplation as the world watches Japan and China's next moves. What secrets might they reveal when the dust settles? Once, the fellowship between the U.S. and its Asian titans, China and Japan, seemed unshakable, with their bonds tightly woven into the fabric of the global economy. Yet, a storm brewed on the horizon, signaling monumental shifts in this alliance. Tensions between these nations simmered as Washington imposed tariffs and technological restrictions, igniting a fierce backlash in Beijing. The realization dawned upon China: it could no longer afford to be vulnerable by relying heavily on American bonds. In a dramatic pivot, China's leadership began a calculated strategy to diversify its foreign reserves, branching out to currencies like the euro and yen, and even seeking refuge in gold. This movement hinted at a desire not just for financial resilience but for economic independence. With whispers of sanctions looming, Beijing hesitated, increasingly cautious about their dependency on U.S. debt. Meanwhile, Japan, while a close ally of America, found itself caught in a web of its own economic woes, grappling with lackluster growth and overwhelming public debt in a post-pandemic era. As the Bank of Japan maintained a policy of easing for an extended period, global inflation pressures crept in, creating a ripple effect on their financial management. Japanese leaders faced a dilemma: to support their domestic markets, they had to reconsider their substantial holdings of U.S. bonds. So, in a shocking twist, both nations independently began to divest their U.S. Treasury securities, possibly offloading up to 45% of their investments. But what lay beneath this significant move? The question loomed: could historical rivals like Japan and China be coordinating in secret? This notion felt paradoxical, considering their past conflicts. Financial markets often transcend political divides, and both nations might indeed be maneuvering to safeguard their economies amidst the raging US-China trade war. What if their simultaneous bond sales were a bold statement to the US, an assertion of power and a warning that America's heavy-handedness could have serious consequences? Yet, it would be too simplistic to label this as an alliance. Experts deciphered the actions of these powerhouses, suggesting that while they acted in parallel, their motivations stemmed from distinct national interests. The crux of the matter was what such a mass exodus from U.S. bonds signified for the American economy. Treasury bonds, once deemed impenetrable, were now exposed, the intricacies of global finance unraveling with every sale. Should we be worried? The implications were profound. With influential players like Japan and China pulling back, what would be the reverberations in the bond markets? Prices could plummet. Yields would surge. The U.S. government would then find itself grappling with higher borrowing costs, deepening its budget deficits and straining the nation's financial health. The whisper of inflation loomed larger, casting uncertainty over the economy's future. As the scenario repeated in hushed tones among financial officials, implications of these sales resonated far beyond numbers. Skeins of diplomatic negotiations surfaced, where the U.S. nudged Japan, urging them to hold off on selling bonds too quickly. In contrast, relations with China, already fraught, strained further. If Beijing persisted, they risked diminishing the very value of their holdings. This delicate game of economic chess holds weighty stakes. The paradox deepens: while both nations may seek to leverage their financial positions against the U.S., they must tread carefully, for destabilizing their largest export market could boomerang back upon them. Questions arise: are escalating tensions worth the potential fallout? The echoes of past conflicts threaten to resurface, complicating an already intricate web of international finance. In the face of such turbulence, one notion remains clear: this isn't merely about dollars and bonds. It hints at a deeper ideological clash, rooted in the annals of history, politics, and economic strategy. The veil that once shielded the U.S. finds itself at risk, prodding speculations of an uncertain future for the dollar's dominance in global markets. As discontent brews, can the American economy withstand the tremors of change that loom just beyond the horizon? The unfolding drama continues, with surprises lurking at every corner, waiting to tip the scales in a global arena fraught with tension and trepidation. In a world of global finance, it may seem strange for two historic rivals like Japan and China to find common ground. Yet, when it comes to the shifting dynamics of their economies and the looming trade war with the United States, they've both begun to take significant steps that could alter the balance of power. What's at stake? Their bond sales have sent shockwaves, hinting at a possible united front in opposition to U.S. economic pressure. Both nations selling their U.S. Treasury bonds signals more than just a financial maneuver. It's a potential warning to Washington: if you continue to escalate tensions, we will strip away your economic dominance. This action isn't one of a clear alliance, as most analysts agree that while Japan and China may be diverging in their strategies, their choices reflect a common goal: protecting their economies from shrinking budgets and inflationary risks linked to excessive U.S. debt. What happens now? If significant players like Japan and China start selling off their U.S. bonds, bond prices could tumble, triggering interest rates to soar. This drastic rise could put the government in a precarious position, increasing budget deficits and heightening the cost of servicing existing debt. There's a sense of tension in the air, and the U.S. Federal Reserve might find itself forced to reconsider its monetary policies, igniting fears of inflation or economic recession. The implications of this situation could be long-lasting. Should the dollar weaken, the U.S. could face profound challenges, both economically and politically. Will the administration initiate secret backdoor negotiations to curb these sales? With strong ties to Japan, the U.S. might feel pressure to convince Tokyo to reconsider its bond divestment. However, with China, the relationship is already fraught, and attempts at confidential talks might prove futile. If bond prices decline as China releases its holdings, the consequences would backfire, leading to a self-destructive cycle. As both countries drift away from U.S. bonds, a critical question emerges: could these actions be orchestrated as part of a larger East Asian strategy to weaken U.S. economic influence? While historical enmities cast a shadow over such cooperation, some analysts see it as an emerging resistance to American pressure. What remains clear is that the landscape of global finance hangs in the balance. How will the U.S. respond to this shifting tide? With rising fears and escalating tensions, the potential for a financial earthquake looms. As the stakes rise, America must confront an unsettling reality: the foundations of its economic supremacy may be at risk, leaving one burning question: how far will these nations go to reshape the global order? As the global financial fabric weaves tighter, whispers of a seismic shift echo in the corridors of power. For decades, U.S. Treasury bonds have served as a fortress for central banks and investors worldwide. With trillions at stake, especially from Japan and China, these economies have long considered bonds a safe harbor. But what happens when that bond begins to fray? In a startling shift, reports reveal that these financial powerhouses have sold around 45% of their U.S. Treasury holdings. Is this an act of defiance, an economic coup, or simply prudent finance? The stakes have never been higher. The recent bond sell-off sends shockwaves through the market, igniting trepidation. Simultaneously, questions loom: are Japan and China secretly coordinating to challenge U.S. dominance? This scenario raises eyebrows. Can two historically conflicting nations unite against a common adversary, risking their own economic foundations? While experts initially dismissed the idea of a formal alliance, there's a growing belief that the tide of U.S. influence is changing. Analysts highlight Japan's discomfort with U.S. economic policies, suggesting that their strategic interests may overlap with China's ambitions. However, Japan's long-standing alliance with the U.S. complicates matters. Should they risk their economic ties to protect domestic concerns? The implications are vast. If major players continue to retreat from U.S. bonds, the value of the dollar could plummet, igniting inflation and potentially triggering a recession. Speculation fills the air: who will be left to pick up the pieces when the dust settles? In this precarious landscape, some argue that while the immediate effects could rattle the U.S. economy, a broader market might absorb any shock. Many view U.S. bonds as safe, and investors from Europe and the Middle East could quickly step in. However, if fear drives yield rates up and the dollar falters, the U.S. must confront the frightening specter of dependency on foreign borrowing. Questions of sovereignty, economic stability, and resilience paint a complex picture. In essence, could this exodus signal a new era of financial autonomy for countries like China? As they navigate this treacherous terrain, leveraging their financial power to negotiate, the consequences remain ambiguous. Is it merely a prudent economic strategy or a deeper political maneuver? The answer may reshape global financial dynamics. The clock is ticking, and with it, the stakes climb higher. Will the U.S. find a way to safeguard its interests, or will these shifting alliances alter the world's economic order forever? Previously, we saw that China and Japan's moves to reduce their American bond holdings are more than just economic maneuvers, they could trigger serious shakeups. Both nations are major exporters, so if they destabilize the U.S. economy, their own companies would suffer too. Yet, selling some bonds seems like a smart move, blending reserve diversification with economic leverage against the U.S. But here's the twist: China often wields the threat of dumping U.S. bonds like a weapon in its trade battles. Beijing loves to warn, if we sell your bonds, your interest rates will soar, and your economy will stumble. Yet, this is a double-edged sword. The very act of selling puts China's own financial holdings at risk. Japan, meanwhile, is generally seen as America's most reliable partner. Still, Japan's leaders know their own economic struggles and might trim their U.S. bond reserves to protect national interests. This ties into a bigger puzzle known as the reverse dollar mechanism. Imagine a cycle: the U.S. prints dollars to cover its trade gap, and the rest of the world funnels those dollars back by buying U.S. bonds, keeping interest rates low and debt manageable. If giants like China and Japan pull out of this loop, the U.S. faces shrinking options to fund its debt, threatening the dollar's crown as the world's reserve currency. Is this the beginning of the dollar's decline? History shows the dollar has survived countless storms, but experts caution that American politics adds fresh vulnerabilities. Skyrocketing budget deficits, rising public debt, deep political divides, and struggles over the debt ceiling shake confidence in U.S. bonds already. Adding big sell-offs by China and Japan could accelerate this erosion. While official voices insist the U.S. can handle this, whispers behind closed doors tell a different story. Economists and financial leaders seem alarmed. Diplomatic backchannels might open. Pressure could mount on Tokyo to slow its bond sales. Beijing's ties with Washington are strained, making negotiation tricky, but all sides understand the stakes. Dependence on foreign powers for economic stability is a national security alarm for some American politicians. So the burning question remains: will China and Japan continue cutting their U.S. bond holdings? Could this lead to a financial storm that reshapes global power? Or will cooler heads prevail, maintaining the fragile balance? The unfolding drama is far from over. What happens next could ripple across markets and nations for years to come. In an unprecedented move that sent shockwaves through global financial markets, two of the world's largest economies, China and Japan, have dramatically slashed their holdings of U.S. Treasury bonds by a staggering 45%. This development raises troubling questions. Why would these Asian giants, traditionally seen as staunch allies of the U.S. dollar, choose to sell off such significant portions of their investments? Is there a deeper strategy at play? Historically, U.S. Treasury bonds have been regarded as a safe harbor for global investors, providing stability amidst uncertainty. Yet, as geopolitical tensions escalate between China and the United States, fears of over-reliance on American currency are driving a shift. Both nations are making calculated moves to protect their economic futures. Imagine the fear gripping Wall Street as these colossal sales unfold. Could this be the harbinger of a financial storm? As markets try to digest this information, analysts are left pondering: is this a coordinated effort between Japan and China to undermine the U.S. economy? Despite their historical rivalries, political alliances are fluid, especially in the face of common interests. Is it possible for two adversaries to find common ground through economic maneuvers, thereby leveraging their positions in the ongoing U.S.-China trade war? The implications are vast. If major players like China and Japan withdraw from buying U.S. bonds, the cost of borrowing for the U.S. could skyrocket. Imagine the scent of panic in Washington as officials scramble to manage rising interest rates, which threaten to escalate the national debt and trigger inflation. Would the Federal Reserve be forced to re-evaluate its strategies, leading to a recession? Despite these uncertainties, some experts suggest that this could be a temporary measure. Perhaps this sell-off is an attempt to rebalance reserves, signaling economic adjustments rather than an outright attack on U.S. financial dominance. Yet, the thought lingers: how much can China and Japan afford to sell without hurting themselves? The paradox of their positions creates an intricate web of strategy, masked by political intricacies. The ongoing tensions are palpable. Japan grapples with its own economic challenges while navigating its alliance with the U.S. How does it balance its dependence on American security with the pressures it faces from trade policies? This precarious dance keeps analysts on edge, questioning whether a lasting alliance could emerge from this climate of uncertainty. As the dust settles from these sails, the pivotal question emerges: what will be the long-term effect on U.S. economic policy? The specter of reform looms large as American politicians begin to contemplate the implications of foreign dependency on their economic stability. Could this shakeup push the U.S. towards more prudent debt management and a renewed focus on reducing trade deficits? Ultimately, the question remains: are China and Japan risking too much by continuing this path? As they navigate their distinct yet intertwined destinies, the entire world watches closely. The financial stage is set, but will the protagonists find their footing? Or will their maneuvers create unforeseen chaos in global markets? In this unfolding drama, one thing is certain: the intricate relationship between these economic powerhouses will determine not only their futures but also the fate of the world's financial landscape. Buckle up as we witness how these events reshape the foundations of economic power and influence. We previously delved into whether Beijing's bond sales aimed to deliver an economic strike on Washington. The likelier truth? Both giants acted on their own, slashing U.S. bond shares and reserves. Mere timing synced them, not some united front. Can you feel the electric hum in global markets? Those whispered rumors of a seismic Asian pact, a shockwave threatening America's financial throne. Is this the moment when historic foes Japan and China team up to dethrone the dollar? Picture the steely boardrooms in Tokyo, the air thick with the scent of polished mahogany and ink-stained ledgers. Leaders there bristle under U.S. trade hurdles, yet cling to Washington for shields against Beijing's rise. Wouldn't it be folly to scheme openly with China? Cooperation hides behind propaganda veils, not real deeds. In Beijing's echoing halls, permeated by the crisp rustle of reports, leaders spin tales for their crowds. See? Japan dumps U.S. bonds too. We could stand as one. But scratch the surface, such unity is a fragile illusion, barely a step beyond words. Oh, the allure of an East Asian bloc sounds epic, like a dragon's tale of vengeance. Why won't it happen? Echoes of maritime clashes and sharp divides keep them apart. Yet, the fallout? A gut punch for Uncle Sam's economy, proving America can't lavish with the dollar's might while forcing others to prop it up. Japan and China, alone or in eerie parallel, unleash market turmoil by unloading those bonds. Even as fresh buyers swoop in, soaring yields hike borrowing costs, a jagged spike in the shadows. Markets buzz: will U.S. bonds risk spike higher? Administrators fret, exposed by towering debts. A shift beckons: tighten monetary reins, curb budget wildness. In the Asia-Pacific haze, this exodus stretches the China-US trade clash. Disputes over tech bans, ocean flashpoints. Beijing wields economic might like a sharpened blade, signaling, push harder, and we'll upend you. Tokyo, meanwhile, pivots to safer yen assets, shedding U.S. ties to steady its ship. The result? Unsettling ripples for Washington, no wins here. Figures demand scrutiny, mass sell-offs sound alarms, but figures slow in official vaults. Implicit data lags. Wrecking the U.S. engine? A bad bet for China and Japan's export kings, their fortunes tangled like knotted threads. Yet, they court the gamble. What twists lurk if they press on? Will volatility eclipse alliances, or spiral into unseen chaos? Hold fast, the next revelation could shatter your view of global power plays. What if this isn't just economics, but a prophecy of the dollar's twilight? In a world where financial markets are tethered by trust and stability, a seismic shift is unfolding. For decades, U.S. Treasuries have stood as a gold standard in the realm of investments. However, the current landscape suggests that even the mighty can falter. As two of the world's largest economies, Japan and China, have started divesting a staggering 45% of their U.S. bond holdings, the implications ripple far beyond their shores. What does this mean for the global economy? Is there a deeper strategy afoot, or are they merely acting in self-interest? Once seen as a sanctuary during turbulent times, U.S. bonds are now under scrutiny. If Japan and China withdraw their substantial investments, the question arises: are these bonds still the safe havens they once were? The answer hinges on the dollar maintaining its status as the world's reserve currency. Yet, with constant challenges, including debt ceiling crises and government shutdowns, doubts begin to simmer. Could Japan and China be leading a quiet rebellion against U.S. financial hegemony? This decision to sell off treasuries throws the U.S. economy into a precarious situation, highlighting its dependency on foreign investments. If significant players are retreating from U.S. bonds, could interest rates surge? The outlook suggests a precarious balancing act, where a massive sell-off could destabilize bond markets and inflate borrowing costs for the U.S. government, widening the budget deficit. While some experts dismiss the notion of an East Asian alliance, the synchronized actions of these economic giants cannot be ignored. Their simultaneous move sends a cautionary tale to Washington: too much reliance on foreign entities can spell disaster. In response, the U.S. may need to strengthen ties with other investors outside Asia or boost domestic savings. The narrative encapsulates a volatile financial landscape. On one hand, confidence in U.S. bonds may dwindle, prompting massive fluctuations in markets. On the other, new equilibria could emerge, allowing for adaptive measures. While experts argue that others will fill the void left by Japan and China, this remains a gamble. If the political climate within the U.S. continues to be tumultuous, will the dollar's reliability withstand the tides of change? In this unfolding drama of economic strategy and power dynamics, everyone holds their breath, waiting for the next move. The stakes are high, and the world watches closely. As the curtain rises on this financial saga, one thing remains clear: the repercussions of these decisions will echo for years to come, reshaping alliances and altering the contours of global finance. Will the U.S. find a way to reassert its dominance, or are we witnessing the dawn of a new economic order? In the intricate tapestry of global finance, a seismic shift is unfolding. For decades, U.S. Treasury bonds have stood as stalwart pillars of the international economic system, with central banks and investors worldwide viewing them as safe havens. The foundation of this trust has been especially strong in Asia, where powerhouses like Japan and China have poured trillions into these bonds. Yet now, a tumultuous shift is brewing. Recently, reports emerged revealing that Japan and China have sold significant portions of their U.S. Treasury holdings, reportedly divesting up to 45% of their investments. This sudden shift has sent shockwaves through the markets, raising alarming questions. What does this mean for the stability of the American economy? Is an East Asian alliance secretly forming to challenge U.S. dominance? As we dive deeper, consider the backdrop. Both countries have long relied on U.S. bonds to stabilize their currencies and secure their economic footing. Yet, escalating trade tensions and geopolitical strife have compelled them to re-evaluate their strategies. China, facing mounting pressure from U.S. tariffs and technology restrictions, has begun to diversify its reserves, exploring options beyond the dollar. Japan, for its part, grapples with its own economic challenges, including low growth and the burdens of public debt. Intriguingly, the timing of the bond sales raises eyebrows. Could these actions be more than mere economic maneuvers? Could they signal a calculated response to U.S. economic policy? Speculating arises that these two nations, despite their historical rivalries, might be subconsciously aligning against the U.S. Yet, how might this affect everyday Americans? Should fear and uncertainty grip investors, prompting a sell-off in other domains? The bond market remains vast, but if key players withdraw their support, prices could plummet, triggering increased interest rates on new borrowing. This situation could plummet the U.S. into a whirlpool of inflation, potentially stifling economic growth. Examine the implications. The U.S. Treasury market has long been viewed as impregnable. If Japan and China continue their sell-off, who will fill their shoes? Europe, the Middle East, could they absorb the shock? The concept of the dollar as the world's primary reserve currency hangs in the balance. Even in this climate, how will U.S. political figures respond? Some advocate for closing trade deficits and boosting domestic production, others suggest raising interest rates to maintain the dollar's allure. The underlying truth remains clear: the era of U.S. economic supremacy is being challenged. The stakes are high. What will become of the dollar's dominance in an increasingly multipolar world? With each passing day, the narrative unfolds further. New data could shift perceptions dramatically, emphasizing that economic realities are in constant flux. Now, as whispers of possible coordinated efforts between Japan and China circulate, the urgency for political action reverberates. What comes next could redefine global financial dynamics. Will the US forge a path to rectify its dependencies, or will inertia lead to further instability? The answers lie just beyond the horizon, waiting to unfold with breathtaking speed. In the previous segment, we explored how Japan and China's significant sell-off of US Treasury bonds is raising alarms in the financial markets. While some experts believe that the reported 45% divestment may be exaggerated, it's clear that the implications of such moves can shake the very foundations of the US economy, leading to broader questions about the global dominance of the dollar. Imagine a world where the dollar, once an unshakable giant in the financial landscape, faces tremors under the weight of strategic sell-offs by two of its largest creditors, Japan and China. Just recently, they divested nearly half of their US Treasury bonds, igniting a firestorm of speculation. Is this a coordinated act of defiance or merely a prudent financial decision? As whispers of an East Asian alliance grow louder, the implications could ripple through the global economy like a stone cast into tranquil waters. But what happens if this isn't just a wave of selling? What if it triggers a tsunami that could crash against the shores of the US economy? The reality is stark. Should major players in the Pacific Rim follow suit, chaos could ensue. This isn't mere conjecture. The interconnectedness of economies means that a sell-off could cause not just financial pain for America but also for those countries involved. The paradox of interdependence is a bitter pill to swallow. The US is heavily indebted, depending on the world to finance its massive debt. With China and Japan easing their grip, panic could ensue. A mass liquidation of US bonds could send financial shockwaves, ultimately leading to an economic implosion for everyone involved. Selling indiscriminately would only hurt the value of their assets, making tactical selling the more sensible choice. In conclusion, the move by Japan and China signals potential fragility within the US economy and raises urgent questions about its standing in global finances. How will Washington respond? Will Japan and China further diminish their reserves, or will the markets stabilize? As the clock ticks, it's evident that major holders of reserves have the power to influence US debt markets like never before. The political ramifications of their actions could force America to re-evaluate its reliance on foreign debt endlessly. As we watch these developments unfold, an unsettling question remains: is the era of dollar dominance drawing to a close? Stay tuned, as the next chapters reveal the intricate dance of diplomacy and economic strategy that could decide the fate of the world's financial order.